My name is Brian Leni. I'm the editor and founder of Junior Stock Review Premium. And I'm going to be presenting Profiting Through M&A in the junior resource sector. So first, a presentation agenda. I'm going to go through 5 ways you can be a more successful and consistent investor, followed by ranked factors driving M&A, and then an M&A case study, and then a couple words about my newsletter. So 5 ways you can be more consistent and successful. These are also 5 things I wish I had learned before I started putting money into the market. I would have saved myself a lot of losses, and I think this is probably the most important part of the presentation, these 5 things. So first, self-awareness. I think so many people, including myself at times, can get wrapped up in narratives, or whether it's on a metal price or a company, and I think that sometimes you get wrapped up in these narratives and it can take you out of your comfort zone or your competency. And so I think it's really important to be self-aware, know thyself. So first, some of the questions you should ask, what's your knowledge level? How much do you know about mining? Mining methods, geology, mineral processing, capital markets. If you have no background in these things or factors, I think, considering how much free knowledge is out there with the Google search, you can get a nice baseline for understanding the terminology, understanding how a company is pitching you, and the learning process never stops. Next is risk tolerance. Risk is one of those things that I think that sometimes gets, or is an afterthought. It gets thought about after you lose money, unfortunately. And you think about, I really don't like the way that feels. That's terrible. I should have done this. I should have done that. And really, I think people need to look at risk before they get into the market. There's a spectrum of risk in the junior resource sector. You've got exploration on the high end, and on the other end, on the low end, you've got the producers and royalty companies. And so there's a really divergence between how those companies operate, when you can expect to get potential profits, and so you have to give it some thought. Next is duration of investment. There's a lot of quick money, not necessarily in junior resource sector last year, but whether it's crypto, uranium had a nice move. Newbies to the market came in, made money really quick, and I think, especially if they're new, think that's how money is made in the junior sector. And unfortunately, it's not, or at least in my experience. Over the time I've been investing, I've had more sideways to down years than good years, but when a good year hits, it really hits, and you need to be able to, be there for that moment when it does, not get shaken out, like in markets like today. And then the last one, how much time will you spend on due diligence? For a lot of you, I'm guessing that this isn't your full-time job, and I think accordingly you have the number of companies in your portfolio that reflects that. I've seen a couple of guys that do this part-time, and they've got 40, 50 companies in their portfolio. And as far as I'm concerned, there's no way you can track those companies properly on a month-to-month basis and be successful. Number 2, price to value ratio. So there's a quantitative and a qualitative side to investing. And to me, it starts with the quantitative side, specifically with the price to value ratio. In my view, you must be able to quantify the value of a company. And you do this through looking at the balance sheet and using a discounted cash flow. From here, you come up with a valuation of the company and you compare it to its market cap. And you're looking for a differential. Potentially, the bigger the differential, the better. That said, you also need to think about the validity or why that value or that discount is in the company. Is it a lack of promotion? Is it an unfavorable metal price? Maybe it's an inability to raise cash. These points, I think, they can be overcome. But on the other hand, maybe it's a mineral processing issue or it's a permitting issue. First you have to think, am I qualified or do I know enough to be able to make a call on whether these guys are going to be able to overcome a mineral processing issue? Or maybe the permitting is something very local to where this deposit is located. And overall, I just think that you probably want to stay away from those other two, especially if you're new to the sector. Number 3, markets are impossible to predict. If you're bullish on a metal, buy the metal. And what I'm trying to say with this slide is there's a big distinction in my mind by being bullish on a metal and being bullish on a junior company. The junior companies have a plethora of other risks, and you can be right on the your metal price thesis, and you can lose money by the junior. You've got people risk, cash risk, permitting risk, processing risk. There's a lot of ways you can lose money in a junior company. And there's a quote from Nassim Taleb, and he says, "Why is the theory never right? because we never know if all the swans are white. And all I mean in context to this slide is that don't be too tied to any metals thesis or company thesis, because it can change as new information comes, and you need to be able to move with the flow. Number 4, sell price. So in number 2, I talked about how important it was to buy at the right price, but in my view, it's just as important to sell at the right price. Too often I've heard stories, and I've actually done this myself on a couple of companies. You do the investment thesis, it works out, the share price is rising, and you think, oh man, this is going to the moon. And then it comes down a cliff, and you ended up in a market like we're in today, and with the amount of fear, a lot of people will sell. And they either lose money or maybe break even, maybe at best. And I think the bottom line is you need to be able to de-risk your investment by taking profits. You need to learn how to sell. Number 5, rules to invest by. So I'm an engineer. I worked in steel manufacturing for 10 years out of school. I had a steady paycheck. Every 2 weeks, money was put into my bank. I did my job. I never had to worry about the money being there. 2016, it was totally different. I left that career behind and I became an investor full time. As many of you could probably hypothesize, it's not exactly a steady paycheck in the junior resource sector as an investor. And I wanted to come up with a way to be as successful as I can be and consistent. And I did this by creating a set of rules. And really what it is a framework for decision making. And if you go back to point number 1, know thyself, the framework is built off the back of knowing what I know and what I don't know, and how much risk I want to take, the duration of my investments, and this really directs me with where I want to put my money. And some potential rules to implement: I only invest in royalty companies. I only invest in companies with projects in North America, or management has to own 5%. You start putting rules like this, and then that daunting task of going through the thousands of listed companies on the exchange become much easier. This will wipe out 80 or 90% if you're true to yourself. So moving on. So what causes share prices to rise in the junior sector? So you got discovery, metal price appreciation, a change in market sentiment, production and royalties, and mergers and acquisitions. And M&A is what I want to talk about today. So when I'm looking at M&A, and I've got companies in my portfolio, I always do a ranking of the companies, and that's something I do in my newsletter. But I'm constantly changing stuff as new information comes. And these are the points or factors I use to rate the M&A attractiveness of a given company. So the first factor I use is jurisdiction, followed by economics. Number 3, resource or reserve size, and number 4, intangibles. So number 1, jurisdiction. So in my view, I think the majority, not all, of the M&A that we see moving forward is going to be propelled by jurisdiction. I think companies are going to want to buy deposits or projects that are located in locales, on the micro level, probably even more important than the macro level of where they're already operating. They've already either developed the mine or operating the mine in this community. They've got social license, and it's more important than ever to have that. The next is reduction in cost. So if you can imagine, you've got a mining operation with a mill that's sitting at 50% production. In my view, I think these guys are drawing 50-kilometer circles or 100-kilometer circles around their operating mill and saying, what are the best deposits? Where can we find other ore to bring in? And you're doing this to reduce cost, especially in this high inflation environment. You're reducing infrastructure, you're reducing personnel, and potentially you're reducing permitting risk too, because you're only permitting the mine, not a mine and a mill and maybe a tailings facility. Some recent examples of deals that I think were driven by jurisdiction: Nevada Gold Mines, the JV between Newmont and Barrick; Agnico Eagle acquires TMAC and Nunavut; Yamana acquires Wasamac; and Eldorado acquires QMX. And 3 jurisdictions I think you should watch: Abitibi, in particular Val-d'Or, Ivory Coast, and Ghana. Number 2, economics. And this really could be maybe a 1B, because while I think jurisdiction is going to be a main driver for M&A, I don't think you're going to see senior mining companies buy deposits or projects if they aren't economic. So it goes hand in hand. The other side to it is, I think obviously profitability is going to be at the top of their list. They want to see low and all-in sustaining cash costs, preferably first quartile, high after-tax NPV, and the big one I think, especially right now, is the greater than 25% after-tax IRR, that return on capital, with everything that's going on in the world. And then the other point is the company's selling at a discount. I think just like as an investor, senior mining companies want a discount to value for that margin of safety. The development risk, CapEx overruns, startup issues, I don't think they're going to want to pay full price for these companies. Number 3, size. Size matters. The bigger the better, with the caveat that it has to be economic at today's prices. In terms of production size and in terms of gold, I think a minimum of 100,000 ounces a year is kind of where you want to target. And to me, it's all about resolution. So if you have a 1 million ounce per year senior producer, they had 100,000 ounces in production, that's a 10% bump, and that's meaningful in my view. Versus a 3 million ounce per year producer adds that same 100,000 ounces, it's only 3%. So you can see the difference here. And this is why Barrick targets those big mines. They want to have a big impact to their bottom line for the risk that they're taking. The caveat with Barrick's goal is there just isn't as many 5 million ounce deposits out there as there maybe used to be. In terms of mine life and in terms of gold, I think you're looking at 10 years. For base metals, it depends on the deposit, but maybe 15 to 20. And then a large company land package. So I put 1,000 plus hectares down, but I think what you're really mainly looking for is that the senior mining company looks at the deposit and doesn't foresee any encumbrances to expanding that deposit potentially in the future or building infrastructure. But the 1,000 plus hectares, then you have the potential to add additional discoveries, which I think, again, in this market, it's a nice bonus. Number 4, intangibles. So you're not going to find intangibles with every company out there. It's just not going to happen. But I think when you do, it's definitely something you want to pay attention to. So you look for a management or a board member that's got a connection to the senior miner, has worked for them, or maybe made a past deal with them. I think that senior mining companies, like people in general, like to do business with people that they know and have had success with. And then the other is the senior mining company has a board seat. And or then recent or maintained strategic investment, 10% being kind of like that bottom line. And the more developed the project, the more that interest I'm bullish on. So the closer it is to a feasibility study, the more I think that there's keen interest to buy it. So here's a case study. So in July of 2020, I identified Monarch Gold as selling for less than it was worth. And because of where they were located, I thought, you know what, these guys are a top M&A candidate. And so I added them to the portfolio, and these are the reasons why. So first and foremost, in the jurisdiction, located in the Abitibi, just west of Val-d'Or. Val-d'Or, in my view, is probably the best place for gold mining in the world, but that's arguable. And I think companies want to be there. Followed by economics. So you can see Wasamac was a feasibility level study project. At $1,300 gold, if you look through the numbers there, quickly you see the after-tax or IRR is 18.5%. I actually think it's not investable at that gold price, but at $1,800 or $1,900 gold, it actually looks fine. The point I want to make, though, Wasamac is clearly not a tier 1 project, but Yamana wanted it. And why I think they wanted it is because they wanted more exposure to that area, that West Val-d'Or area. The size are right in line with the numbers that I put. And then the intangibles is really what tipped me off that there's probably going to be a deal coming. So I went back through the old news releases, and I saw that Yamana participated in the spring 2020 financing, and they requested a board seat. You mix this in with Monarch's management team's history of deal making, and I thought, oh man, you know what? There's probably something going to happen here. And then sure enough, in November, Yamana bought Wasamac and Camflo for $200 million, and it was a great win for myself and my subscribers. So picks, the 4 companies that are presenting with me today, just a couple words. We've got Aztec Minerals. Really, they've flown under the radar the last year. This is despite some great drill results. Most recently with Cervantes, 1.5 grams over 136 meters. That didn't go unnoticed, though. Alamos Gold just put in $3 million to obtain 10%. Then you have Canstar, over 700 square kilometers of claims around the Hermitage and Day Cove thrust faults in Newfoundland's Central Gold Belt. They made the Kendall prospect discovery, 9.6 grams over 7.8 meters, and they're fully funded for this year's program. Nucor, I think, is a top M&A candidate, and she has both good size and economics. PEA, over $300 million US, after-tax IRR, 54%. This is an oxide gold project, low upfront CapEx, under $100 million US. And I think one of the bigger parts is that they're located in Ghana. Senior mining companies want to be there. 6th largest producing company. The country that's just ahead of them, Canada. So it gives you perspective on Ghana. O3 Mining, another top M&A candidate. exploring and developing the 2.6 million ounce Marban gold project in the heart of the Abitibi. They've got a PFS coming out in Q3, and they're also exploring their 100% owned Alpha property. And there's a resource coming out on the Bulldog sector, and that's expected in Q4. High insider ownership and expertise. Great company. Junior Stock Through Premium. My newsletter is published weekly. I go through market commentary, research that I do, portfolio review videos once every month or two, and I do a portfolio ranking every week and with buy at and below prices. The premium portfolio currently has an average return of 70.4%, which is pretty good given the market, and some of my big winners over the last 2 years are right there. If you're interested in the newsletter, or if you have any other questions for me, please let me know. Thank you.